Hey guys, super happy to be here once again in our show, the TradePod. And today we have Jit. Jit, super excited to have you here. In most of the occasions I speak, I give a small introduction about the guest, and then they start talking about themselves. But I think that time I will change my tradition. I think that I'll evolve my tradition into something much greater, and I'll let you to present yourself to our audience. So first of all, I'm super happy and pleased to have you here in our show, The Trade Pod. How are you today?
I'm feeling great. Like Bitcoin just hit 100K today, and it's a great.
Congratulations to everyone. Congratulations. Let's just give it a clap. Let's just give it a clap. Let's give it a clap. Yeah,
It's,
but besides the 100K for the Bitcoin, I'd like to hear a little bit more about yourself. So, who are you?
I have an undergrad in engineering and a postgrad in financial engineering, and I've been trading for the past 8 years now. I started out as a prop trader. I've been trading funding arbs, synthetic arbs, and many factors. Gradually, I moved to market making. I worked in an exchange as market maker, gradually started heading the market making in the exchange, and I currently work in a hedge fund in Dubai as a prop trader.
Mhm. Prop trader, prop quantitative trader.
Yeah, to be precise, yes.
Hmm.
High
So,
frequency trading and high frequency trading and market making is my domain.
mhm. Now let's just have a small recap about yourself. So, you have an undergrad engineer in electronics, and then you went to learn quantitative finance from World Crime University. So, every time that I speak to some of their grads, I really I really want to hear about their experience learning at an institute that is hyper focused on quantitative trading and the quant finance specifically. Um, so let me ask you this: how was your experience learning at Warcraft University, and what changed or what evolved in your aspect over the markets over the time that you have learned quantitative trading?
Major shift was trying to unlearn what I already know as a trader because I started out as a retail trader, which had to be taken out to be able to see the market in a quantitative, numerical pattern recognizing angle, which required me to let go of things that I know and start from the scratch, which really helped me, which helped me shape my career in for the greater good, I would say.
Mhm. Good. Now let's jump over your domain, high frequency trading and market making. So let's just have a separation. High frequency trading does not necessarily mean that you're going to be a market maker, and conversely. But let's just speak about high frequency trading for a while. Now, in speaking about the architecture behind having a high frequency trading strategy behind you, you need to you need to have you need to be you need like to have proper research behind yourself and to find somewhere that you can really execute it. Now, I would like to ask you if I would like to trade right now one of the most volatile and one of the most liquid assets, like separated. I want to trade a volatile market and I want to trade a liquid market. How would you go and tackle the problem as an engineer and think about a creative solution to craft an algorithm to trade those markets over a long period of time?
So first of all, high frequency trading falls under I'm going to trade on a very minute angle, like meaning millisecond is the area that I would be trying to play at. So when you're talking about volatility, first I want to understand if volatility is my friend or my enemy. And in order to know this, first I will have to observe the asset and be able to understand the nature of the asset and the volatility of the asset, for which I need a certain level of data getting collected. So that is the
And
main
how
area.
do you calculate, if the volatility is an enemy or a friend? Like hypothetically speaking, you got the amount of data that you wish for. For let's throw an asset. Let's go for the NQ. All right, sounds good. Now you have the amount of data that you wish for, and right now you're trying to tackle the understanding about what's the nature behind the underlying assets, and what's the nature of the trading instruments. Now, how do you tackle such a problem with the amount of data that you wish for on the first hand?
So it depends on what I want to do with the asset in the first place. So I am looking for factors that will help me trade this particular instrument or asset. So what is the thing that helps me or will motivate me to participate? I should have certain level of alpha component. So what is my alpha component and what is it, where is it coming from is something that I will first have to understand. And if it is going to be highly volatile, I would want to uh, have a scalp at the market, or if I want to hold the asset, and what is my bias in the particular instrument plays a heavy role in my participation.
Mhm. Now, I would like to, if it plays a heavy role in your participation, I would like to ask you how do you calculate like the impact that you're going to be having while participating in a real volatile book in a real liquid book for such a liquid instrument like the IQ.
If it is liquidity that I seek, there are so many assets out there which has very deep liquidity. So that is not the area that will motivate me to begin with. The factor research that I would be trying to build on is the area that will motivate me, because that is where the work occurs. Like what really is my alpha. We just in general we have a say out there with market makers, like if you don't know what your edge is, then you are the edge. So it's a thing that we have in the markets. So it's about first understanding what you have and what you are looking for, and after which we decide the instrument, we decide the asset, and then start.
Mhm. I understand, but I'm not sure that I quite catch the thinking behind how do you craft an algorithm and an HFT algorithm. Now, I know they it's like there are subjects that are prohibitive to talk about. But I would like to ask you this. Um, when having the understanding of the nature of the asset, and you have calculated if the volatility is a friend or an enemy, um, now what's the next step? What do you wish for?
I want to be able to model the order book in a way which I am able to take advantage of. And if if the order book shape is more suiting to my order placements, then that is where I would like to grill. That is exactly what I would like for the uh, asset to behave, as well as myself being able to participate.
Hmm. Yeah, but this is a story. Let's go to the nitty-gritty. Let's give us an example. Give us an example. What do you mean? If I would see that I do not fit to the order book, then I will.
Yeah. So what I would be doing is, first of all, if my factors are pointing towards, let's take one factor, for instance,
Yeah.
the U.S. elections. The U.S.
Mhm.
elections was a big movement, which was something that we were all expecting. And if we had a close follow of the elections, when and the Trump won the election, we obviously did know the people who are behind Trump, which was Elon Musk, who was a big supporter for crypto in general. And Trump even was very outspoken about his attitude towards digital assets in general. So, which is a huge, huge positive drive force. In a general market, these informations are factored in at a much quicker rate. However, in digital asset market, this had an upside which was unfathomable, which puts us all on a bullish bias, coupled with more volume pouring in, with more institutional money pouring in. And if we were long at this particular point of time, all we had to do was take a naked position, naked call, meaning like in options we say naked call. It's like just
Mhm.
buying with a call gives you an inherent 100x leverage is what we understand. So we can just directly go and buy a call. It was that simple, and the asset performed 50% upwards. So it's like a huge rally of whatever assets that you were having, and it was the information was very obvious for people in the market. So these are areas that we are able to understand it much sooner by being able to uh, check the order book in a rate which is like far quicker than any other participant in the market. We would be the first one to place the orders.
Mhm. So, you know what? All right. We just spoke about the US elections when Trump got elected. Great. Now, this is a really rare occasion, and we already know if Trump will be elected, then what will be the outcomes because what the Republican have prioritized when they ran the campaign. And conversely, speaking about Miss Harris and what she determined to be her rule of thumb when she will be elected if and over time we were aware that she's not going to be the US president for the next four years. Now, without further ado, I would like to take it onto much less rare occasions, like fundamental news, CPI, PPI, NFPs, because when you participate in the market in such a way, you see that while CPI is taken apart, you see a much less liquidity in more volatile markets that might be fearful or might be great for the new that recently came out. Now, when you actually see the great reveal of the number behind the CPI, the candle and the market is already moving, and that's I think the one of the greatest examples of HFT because you see a big candle, you see price, you see a lot of money comes into the market, and like right now, your position worth two times, three times more because of the amount of money that got into the market. Now, I would like to ask you that, everyone getting the right message at the perfect time. Now, this is a hell of a it's a hell of a problem to enter the market in a millisecond position and move an incredible amount of money. Now, I would like to ask you how, if I get the amount of knowledge and you get the amount of knowledge at the same time, how HFT takes it into much further way to solve that problem that you will be able to move the amount of money that you want or that you wish for.
Yeah. So this is the most interesting part of HFT, which is like very rudimentary even for myself as a trader, because this is the exact reason I moved to HFT from a general trading. Because when you say that you see that the market has moved, your information with seeing the market already comes with a lot of delay, because you might be using some level of interface to have the interpretation that the market has moved, and this interpretation or the visualization angle already comes with a lot of delay, but the delay is at very minute level. So it you don't really consider it as a delay. It could be on second level, or like a few hundred milliseconds. So this by itself, it is undeniable that this by itself is a delay, in fact. So what comes first is the orders, right? The orders. The orders has to come to move the market. So what comes in the market, if it is orders, so who fetches these orders? Where do these orders come from? And how exactly are the sequence in which they are getting executed? If we break this down, the people who are of highest information source available will be the people who are fetching any and every orders that are happening in the market, and storing these information, and organizing it in a set of tabular format, and able to see them in a way it should be seen.
Hmm. It really catches my interest each and every single time that I see a new comes out. It really catches my interest because um you see the big money movers get into the market. Now, I would like to ask you, now taking a step out of the HFT world, but of course with the combination with HFT because this is your main domain, speaking about market making. Now, market making um, is just to provide liquidity. It's like a source or a service to provide liquidity to the markets. Now, first of all, I would like to ask you how the business, like behind market making, actually works. Because when a company approach you, or let's hypothetically say that, let's just a hypothetical example. Here in the TASE, Tel Aviv Stock Exchange, we got a notification that a contract to the leading index ads is available to trade. And when they promoted this new that just came out, they told, yeah, that we brought some great liquidity makers onto the market. Now, when you get an offer as a market maker to come in to move such an instrument that needs more liquidity, how do you structure your participation, or how do you structure in collaboration your participation with the institute that just, that asked for your services? And how do you do it internally, like inside the organization? How do you move the market? How do you think where to move the market, where to move the market? What are the points that you're looking for to move the market, and so on and so forth? Let's hear you for a moment.
So the first thing that we would be doing is, when you say liquidity provision, that is one part of it. So the first question is, how are people able to buy from the market? Who is it selling to them at the right price, or whatever price is considered as right at that point of time? The market makers. The market makers are the people who help in the participation of the external agents. So this comes with an inherent idea. If you think about it, why are people buying a certain asset? It's a question I want to ask you. Why do you think people are buying or selling an asset?
You ask me why people are buying and selling an asset? In order to make money, in order to make a profit.
So If you
Or if
think,
I'm wrong here, if I'm wrong within my point of view, this is because I'm not a market maker. Big disclaimer to all the listeners, but you are the market maker. You will tell me the truth.
yeah, yeah. So the main thing here is people buy a certain asset expecting the price of the asset to go up. So what about the counterparty here? Like we sell the asset, and what are we losing here? We sell the asset, which people think is going to go up. So does it mean we are losing money here? And again, at the same time, people directly sell us assets, which they think is going to go down in price, which means we are buying risk basically. Whatever the counter player thinks is going to happen, we are on the counter side of it. If you uh, to make myself clear again, people buy assets from us thinking it will go up. So we are selling assets that could possibly go up. At the same time, people sell us assets that they expect to go down. So we are buying the assets that could potentially go down. So we are buying risk. And what do we get for the risk is the question that we should try and answer. And what we get for the risk is that we understand markets in a way that market is 70% sideways and only 30% trending. And what is sideways and what is trending is something that we will define based on the prices that we quote and the prices that are getting executed. So the way we offset the risks that we buy will be layered in sophistication of multi markets at the same time in the order book with a lot of conjuncture of whatever orders that are coming and whatever orders that we want to offset. So we have, hence, we require a lot of infrastructure requirements. Since we are buying so much risk, we'll have to have eyes on everything that's happening out there.
Mm, I get it. No, it's a really interesting topic, market making. Now, speaking about, you know, there are aggressive buyers and there are passive buyers conversely to sellers. Now, I would like to ask you, when you are in the middle of the two levels, the supply zone and the demand zone as a market maker, and you're asked to move the price to a desired place, how would you practically execute such mission?
So since we actually do not have any angle towards supply or demand zone, it could be coming from the retail participants, and retail participation will have a certain level of bias. We look at traders in two ways. One is the informed trader, and one is the uninformed trader.
Yeah, but
So
I'm not speaking, I'm not speaking about retail participation. It's literally not interesting. Honestly, I'm speaking about people who really desires to move the market in such a way. Now, hypothetically, you're working with a bank. I'm just here to brainstorm with you about how would you execute just such a mission. Now, I'm a manager for the trading desk in a bank, and I'm asked by one of the greatest companies in my country to I don't know to take dollar to ILS Israeli shekel. Now I need to take a certain amount in a fair price that I think it's fair for my clients and to transfer the money onto ILS. Now within your participation as a market maker, like and as a liquidity provider, I will not be able to drive the price and to get onto the level I want to provide best for my end customers. I hope that I explained my situation good. in a really sophisticated way. Now, you, as a market maker, should provide me with a much comfortable zone for entry and exit because dollar to ILS is a really exotic currency pair. And, the amount of liquidity is much less than euro dollar, of course. Now, speaking about that sense, I would like to ask you how, like, as a market maker perspective, how would you track or how would you solve those certain occasions in a term that will benefit all the parties that are active on those situations?
Yeah, yeah. So, primarily, I would answer this from the perspective of myself being the market maker. I do not have the knowledge of trying to solve anybody's problem, being the market maker. My goal will majorly be to help people trade as well as possible. And it will not cater to any particular agent participating in the market. And markets in general are connected across many other markets. If I am participating in a certain order book, I will be able to provide a certain level of depth in the order book. And if a particular agent or a particular entity is
Let's
trying to
let's I would stop you and I would like to speak a little bit more about death in the order book. Um, let's just let's just speak about that topic because I want to have much more proper understanding about death in the order book. What do you mean in providing much more death in the order book?
the order
How do
book
you
has,
practically make that?
yeah. So the order book will have several levels in which you will be able to trade. So the first level, meaning the first tick size of the orders, and the first tick size of the orders will have the least level of depth. If you notice, meaning it will determine the spread, and the spread will be low, and it will have the least level of depth because it has the least level of profit for the market maker. And the further levels as it grows up, it will have higher depth because it will help me capture the spread. So the spread is the profit of the market maker.
Hmm. Now, I stopped you. I stopped you for speaking on the previous question. So I'll take you on the last story that I'm a trade desk manager and I want to take dollars onto ILS Israeli shekel. Now, you with the point of view of a market maker, how would you help me to get to the fair price that I wanted? I stopped you in the place of like death in the market.
So I would First of all, I cannot facilitate a particular participant in the order book. If it is going to be something that I want to facilitate, it will be post-market angle is what I would be able to facilitate huge orders, and huge orders are always executed in exchange ETF trade sort of fashion. But if I want to facilitate him in the order book, and I will be moving the spreads which are much favorable for myself, and the participant being able to take advantage of whatever is there, who does not mind paying a higher spread to myself, will be able to take advantage of it that way.
Mhm. I get it. Now, speaking about like more over the congruency between HFT and market making. Now, speaking about that certain occasion, how HFT really gets into the logic of a market maker. How do you take advantage of our HFT algorithms that you own onto delivering those market making services?
We will have to talk about the players that are involved in HFT uh, to better explain this. So, what is the background of people who are participating in HFT? are physicists. Basically, they are people who have a higher knowledge of theoretical physics. I have met people who are good at nuclear physics, and the way they layer their ideas that will help them understand the the better word is physics. The the layering of their knowledge that they can concentrate and be able to predict in a reasonable way is what gives them the edge in order to be able to participate in high frequency trading.
Hmm. Now, from your point of view, why do you think that, physicist point of view will help to predict certain price movers in the future?
Because of the concepts that I have come across, they are from physics. I must say, especially computational finance is full of physics, and there is mathematical finance, people with mathematical finance backgrounds, and they are able to see things or explain things in a way which are new to people in the market, and it is always fascinating in that sense.
Mhm. All right, sounds fair. Sounds fair to hire physicists for an HFT business. Now, um, don't you think that you are observed with the right knowledge as physicists are to craft an HFT algorithm?
The main goal to be to participate in HFT is pretty much out there for everybody. The companies that are participating or in the market making or HFT programs are pretty much given their job description out there. If anybody can crack their strong interviews, then they get access to information that will help them understand the elaborate code base that they have, and be able to digest what is there, which will alter their trading perspective in a way which will be very unique. And it is quite an experience in that sense. So first they will have to understand what is out there, and then conceive their ideas to able to take advantage of the market. So that is very significant.
Hmm. Hmm. I understand. I understand. Now, you know what? I do have one last question to ask you before we rate that session. I would like to ask you this. Now, if I were about to join a market making company, what is the most uh, sophisticated kind of education that we need to have in order to be properly aligned with all the needs and wants and desires for the organization.
There are two ways here. One is the quant research way, which is someone like myself who likes to research and develop factors that will help the market. Or the other way is the infrastructure builder, which is the devs. The developer can improve their sophistication by coding in C++, which is majorly used, or C sharp, which is used as well, or the hottest language for the high frequency trading right now is Rust. That could be an another portal through which they can enter the high frequency trading domain.
Mhm. I understand. All right. Now, I would like, first of all, to thank you for your participation. We had a great conversation speaking about HFT and market making. I really like the way that the conversation went, and thank you for the amount of knowledge that you have provided us today. So first of all, thank you again. I had a pleasure having you on our show today, and thank you.
Likewise, I really did enjoy the conversation, and thank you for having the time to politely listen to every areas of the high frequency trading that was explained. And I understand that it has perked the interests of anybody and yourself in
You're
particular.
right. You're right. You're right. You're right. You're absolutely right. So, Jay, it was a pleasure having you here on our show. Bye bye.
Likewise, thank you.